On the 12th of May, at 7:30 in the evening, the Australian government rewrote the rules of property investment for the first time in nearly 30 years. 3 weeks before that, the Reserve Bank had raised interest rates for the third time in 4 months. And by July, house prices across the country were falling at the fastest rate since 2022. Any one of those things would reshape a housing market. All three landed inside 90 days. So here is the question almost nobody is answering properly. If investors are pulling out, and prices are going down, and the market is finally cooling, why is buying a home harder today than it was at the peak? To understand where we are, you have to understand how fast the ground moved. Through 2025, the Reserve Bank was cutting. Rates came down 3 times. Borrowing capacity went up. Buyers who had been priced out for 2 years came back into the market, and prices climbed to a record high in October. Then inflation came back. Not the inflation of 2022, not supply chains and stimulus. This was different. Government energy rebates that had been quietly holding household power bills down came to an end. Conflict in the Middle East sent fuel prices sharply higher. And in the March quarter, automotive fuel jumped more than 30% in a single month. Headline inflation hit 4.6% in March, the highest reading since September 2023. So the Reserve Bank reversed. In February, March and May, it raised the cash rate 3 consecutive times, from 3.6% to 4.35%. 75 basis points in 4 months. And the major banks passed every single one of those increases through to variable rate customers, in full. The people who bought at the top of the market in October were, by May, paying hundreds of dollars a month more than the loan they had been approved for. Now here is the behind-the-money reality of what a central bank actually does. The Reserve Bank cannot manufacture more oil. It cannot end a war. It cannot build a single house. When it looks at an inflation problem, it has effectively one lever it can pull, and that lever is you. Follow the mechanism. The average Australian taking out a home loan today is borrowing $734,000. At the current average variable rate of 5.9%, that is $4,359, leaving a household account every month for 30 years. Now push the rate up. The loan does not shrink, the house does not change. The only thing that changes is how much of that household's income the bank takes before anyone gets to spend a cent of it. And that is the entire point. If $4,000 a month is going to your lender, you are not renovating, you are not booking flights, you are not upgrading the car, or eating out on a Friday, or bidding aggressively on anything. Millions of households make that same adjustment at the same time. Demand across the economy falls, and businesses lose the ability to raise prices. Your financial pain is not a side effect of the policy. Your financial pain is the policy. It is the transmission mechanism. It is how the medicine gets delivered. And it is worth sitting with how blunt that is. The Reserve Bank is not targeting the fuel price, or the energy rebate, or the war. It cannot reach any of those. So it reaches for the only thing it can hold, the mortgage, and it squeezes until the rest of the economy lets go. So the textbook is clear on what happens next. Rates go up, borrowing power collapses, house prices fall. And for once, the textbook is right. Prices are falling. In July, national home values dropped 0.7%, the largest single-month decline since December 2022. Sydney fell 1.4%. Melbourne, 1.2%. And this is no longer a two-city story. Brisbane and Adelaide, which had been holding up all year, both moved into decline. That was the 4th consecutive monthly fall. By PropTrack's index, national prices are now 1.8% below their peak, with the median dwelling sitting around $894,000. The rest of the market is behaving exactly as you would expect. Auction clearance rates across the combined capitals have slipped into the low 40s, a level that historically signals sustained price falls, not a soft patch. Total listings in the capitals are running almost 6% above the 5-year average. Sellers are waiting, buyers are not moving. This is the moment first home buyers have been told to wait for 4 years. And it is not helping them. Here is why, and this is the part almost nobody explains properly. A price is not what you pay. A repayment is what you pay. When the Reserve Bank added 75 basis points, it did not just make your existing loan more expensive. It cut the maximum size of the loan a typical borrower can be approved for by roughly 7 to 8%. On a $700,000 approval, that is something in the order of $50,000 of buying power, gone. Not spent, gone. Meanwhile, prices have fallen less than 2% from the peak. Run those two numbers against each other and the result is genuinely bleak. The house got slightly cheaper, your ability to buy it got dramatically smaller. The gap between what a first home buyer can borrow and what a home actually costs is wider today than it was when prices were at a record high. Falling prices do not rescue you when the thing falling faster is your borrowing power. And then, in the middle of all of this, the rules changed. On budget night, the 12th of May, the government announced the most significant reform to property tax in a generation. It is not a proposal. It is not under consultation. It is passed. It is law. Two changes matter. The first is negative gearing. From the 1st of July, 2027, negative gearing on residential property will be limited to new builds. If you buy an established home as an investment after budget night, you can no longer offset a rental loss against your salary. You can only offset it against rental income or carry it forward against a future gain on that property. Anyone who already owned before 7:30 on budget night is grandfathered. Nothing changes for them. New builds are exempt entirely. That is deliberate, and it is the whole design logic. The government is trying to redirect tax support away from bidding on existing houses and towards creating new ones. The second change is bigger, and it has had less attention. The 50% capital gains tax discount introduced by the Howard government and blamed by a long list of economists for Australia's affordability problem is being replaced. From July 2027, capital gains will instead be indexed to inflation, with a minimum tax rate of 30% applied on top. To understand the scale of what is being unwound, negative gearing alone reduced Australian income tax revenue by almost $11 billion in a single financial year. For decades, the deal was simple: buy an established property, run it at a loss, deduct that loss against your wage, and collect a discounted capital gain on the way out. That deal is being closed. The immediate effect is already visible in the market data: investor demand pulling back, contributing to the falls we just walked through. The long-term effect is the open question in Australian housing. Does the tax change actually push capital into building new homes, the way it is designed to? Or does it simply remove buyers from a market that is already short of supply? Nobody knows yet, but you are living through the experiment. Now let's talk about the bills, because this is where most coverage gets the story backwards. Electricity is 22.4% more expensive than it was a year ago. That number gets reported as energy companies gouging households. It mostly is not. For 2 years, the federal and state governments were quietly paying part of your power bill through energy rebates. Those rebates have now been used up and ended. Strip the rebate effect out, and underlying electricity prices rose closer to 5%. Think about what that means. The subsidy did not make power cheap. It made power look cheap. You are now seeing the real price for the first time, and it arrived all at once. The same pattern runs through everything. The cost of building a new dwelling is up 5.8%, the fastest in almost 3 years, as builders pass through higher material and labor costs. which is exactly why the supply response everyone is counting on is so slow to arrive. Fuel spiked on conflict offshore, and fuel does not stay in the fuel category, it rides inside freight, and freight sits inside the price of nearly everything on a shelf. And insurance keeps climbing faster than headline inflation, as global reinsurers reprice Australian climate risk and pass that repricing straight into a household premium. You are not only insuring your house, you are helping fund the risk across an entire continent. None of this is discretionary. You cannot cancel your power. You cannot cancel your commute. You cannot go uninsured. Which is exactly why the Reserve Bank has to squeeze the one part of the budget that can be squeezed. And why it lands the way it does. There is one more number worth holding on to. Almost 57% of Australian household wealth is held in residential property. Not in shares. Not in super. In houses. That single statistic explains a great deal about why no bank, no government, and no central bank in this country has any appetite whatsoever for a genuine property crash. So after all of that, the hikes, the squeeze, the falling prices, is any of it actually working? Yes. Slowly. June quarter inflation came in at 3.8%, below what economists had forecast. Underlying inflation, the trimmed mean, which is the number the Reserve Bank genuinely watches, came in at 3.6. That surprise was enough to move the market. All four major banks, which had been split on whether another hike was coming, flipped to expecting a hold. But look closely at what they are forecasting beyond that, because this is the part that matters for your budget. Commonwealth Bank now expects the cash rate to sit at 4.35% for the remainder of 2026, with no cut until 2027. National Australia Bank believes the cycle has peaked and puts the first cut in June of next year. ANZ sees two cuts eventually taking the rate to 3.85. Not one of the majors is forecasting relief this calendar year. And the reason is that the Reserve Bank is watching an economy that is slowing but not slowing cleanly. Unemployment has risen to 4.5%. Quarterly growth has come in at 0.3%. Inflation is falling, but it is still sitting above the top of the 2 to 3% target band. Which leaves the Reserve Bank exactly where it wants to be, and exactly where you do not. Restrictive, patient, waiting. Inflation is cooling. Your mortgage is not, so let's finish somewhere useful. You cannot set the cash rate. You cannot fix the construction industry, or reverse a tax change, or end a conflict on the other side of the world. But there is one number in your financial life that you can move this month, and most Australians have never once tried to move it. Your interest rate. Here is the spread, and it is worth understanding precisely. The average variable rate on a new loan in this country is 5.9%. The big four banks' advertised variable rates sit closer to 6.5%. The most competitive lenders in the market are writing loans at 5.69%. On that average $734,000 mortgage, the difference between a big four carded rate and a sharp one is about $380 a month. More than $4,500 a year, every year, for one phone call. That is the loyalty tax, and it is worth being blunt about how it works. Your bank offered 5.69% to the customer who walked in yesterday, and left you sitting on 6.5%, not because your circumstances are worse, but because you did not ask. Loyalty is not rewarded in Australian mortgage lending, it is billed. And Australians are finally catching on. In the March quarter alone, owner-occupiers refinanced more than $42 billion worth of loans with a new lender. That is the highest figure ever recorded. Note something in that data: 98% of new owner-occupier loans in Australia are variable, which means almost every borrower in this country is directly exposed to the cash rate, and almost every borrower can move. So here is the task: and it takes 10 minutes. Open your banking app tonight. Find the interest rate you are actually paying, not the rate you signed up for, the rate on the account today. If it starts with a 6, call your lender, tell them what the market is offering new customers, and ask them to match it. If they will not, a broker will run 30 lenders in a single appointment, and it costs you nothing. The macro environment is not going to rescue anyone this year. The Reserve Bank has told you that plainly. But the $400 a month sitting inside your own mortgage is real, it is yours, and it is available right now. That is where the leverage is. If you want to keep understanding the hidden forces moving your money, the ones that never make the headline, subscribe. We go behind the number every week. I'll see you in the next one.